All right, I welcome everybody to our little kind of mastermind out of state investing. And as you guys know, and if you might not know me, but if you don't know me, my name is Lenska, and I'm a real estate broker, but I just realized I have been investing in in 20 years. So I started out with fix and flip, held something, 1031 exchanged it into 5 or 6 different markets in from Florida to Mississippi to Idaho to where else was I? In Utah. I have never been in Phoenix. It's simply too hot for me there. Okay. So but that was like 15 years ago. Times have been different, right? You didn't have all the modern tools we know we have. And now it's pretty much easy to do anything from your couch, I call it, or in your PJs, right? We know San Diego is home prices have gone to the moon. So I have a YouTube channel. So because these meetings are free, and Kimmy and Bill are sharing their wisdom. I share my experiences. I think this is more worth than some rah-rah show or some YouTube sensationalist just telling you, crazy things. So I have a YouTube channel, and please, join it. So I'm taking off to the moon with the house prices, right? So that's kind of what I do. I help people buy and sell. So I want to go into some of the due diligence, and that is you can all look that up in that video. But this is for single family houses, right? How do we even start looking which towns are good to invest in and which are not? So believe it or not, Riverside did pretty well. It had some good appreciation, but people still can't afford it, right? So look at San Diego. Everybody on the call said, hey, San Diego is too expensive because the home ownership cost and to annual earnings, I don't know if I had San Diego now, is 80% in San Diego. Okay, so we know very few properties, unless you add an ADU right now and increase your ROI. And so you can pick, this is nothing but Zillow and Bureau of Labor Statistics. So I want to point out these cities like Fresno, Fayetteville, Cleveland, and Huntsville, right? You see, those are in the 24 to 34% ratio, which means you take 30% of your annual earnings in order to own a home. So these cities will probably fare better if we have a crisis than some of the other cities. You see Fresno and Riverside, how much value they also lost during 2007 and 8 because practically people couldn't afford it. So we are really coming towards an affordability crisis. That's why I think, and that's why I invited Kimmy and Bill, because a lot of people are pushed into multifamily, right? And you can invest into multifamily out of state as much as you can invest in single rented. Now, why are we investing? Look at these record-breaking rent increases. Okay, it's I mean, a rocket is no comparison. It went up 16%, where over all these other years, it practically was pretty steady. So will we see another 16% increase? No. Okay, because why not? 11 million renters haven't paid their rent. So I always have these foreclosure people that want to see foreclosures, right? So there is another way where you can look to maybe get a deal where they are right now maybe having most of the evictions, or will have already started filing for foreclosures. It's not going to be a tsunami. It's not, but remember, inventory is tight all over the United States. So we're looking for a little bit of an advantage, a little bit of an edge to get us as an investor. We want a deal, right? So look in those markets, which Las Vegas is, for example, one where there will be a lot of evictions, okay? So, and that is to the rent growth. I told you not to expect. So how do we analyze a rental property? We analyze it obviously by the rental income we have. Be a little careful. I have the feeling also in San Diego, I have 2 listings that I put on for rent. I don't have 30 phone calls like I used to have, okay? So because rents have really gone high. So if you want to see more of this guy on real estate consulting, he's on YouTube. He's a little sensationalist, but his data, or how the data points he's using to analyze markets, is pretty good, okay? And then we really need to compare practically the median home price and maybe look for foreclosures or evictions. We also need to compare it to the median household income. So ideally, you want a city or town or county or state where the median household incomes is high compared to the median home price. Makes sense, right? People can afford it, and you're a little bit more protected from a crash. So here's median list price. Obviously, we see a red of C, but we see like the Middle West and some of the other Missouri. And are you doing the example for Missouri?
Yes.
Yeah. So that was, Kansas City, Oklahoma, Arkansas, Mississippi, Alabama is under 276. So these are all these yellow markets and orange markets are all pretty good. Where is Atlanta? So Atlanta, Georgia, there's like 40% of the homes are being bought up by investors right now. Okay.
Wow.
Yeah, it's the whole real estate market is investor driven anyways right now, and second home. So you can have your little stats, so you can get those at GeoFred, right? So this was, you see, that was 2021, and look, we got a little redder. Okay, so the ones that got a little redder, might be good for multifamily because people are pushed out of the housing market. Okay, so each data point is kind of different for what you want to invest in, but I just want to tell you one of the major ones. And then before I hand it over to Jim and Kenya, I saw this one because they're doing a little one it's close to St. Louis. But a longtime St. Louis resident, and yay, there are some major problems in St. Louis, but then tend to be confined to the actual city itself. Once you move outside the city proper to the nearby areas, which are sort of part of St. Louis, but also not quite, those problems decrease dramatically. It's also worth noting that St. Louis City has a 1% tax on wages that the outside areas not have. So there's my little warning that each city, or if you go out of state, you're not that familiar with the local things. And obviously the internet and Google has helped us tremendously to do our research, but you have to dig pretty deep. My recommendation, yes, you can do it from the couch, or you have, you really have boots on the ground and somebody that you trust over there. So I know, and then here's the Zillow home value data. Here are the links if you want to guys take a screenshots. And for the wage And obviously each market, we only will see an increase. And also it doesn't matter if it's single family or multi-family. If no people moving into the area and more people leave, like for example, California right now, we lost about 350,000 people. Yeah, we still have a housing shortage because it was crazy, but it's obviously helping us that some people are moving out. Where Florida and Texas and Phoenix all still have positive in migration. So you wanna pick cities that people are moving to, making a lot of money, and home prices are still affordable. Which brings us to St. Louis. It is a typical home value. Don't you love it? We can buy 3 homes for the price of 1 in San Diego. Okay. And the annual wages of 57,000, that is really, it is really good. So with that one, I'm going to stop sharing because now we have a little case study of something close to St. Louis. That's the main market. Bill, and I'm going to stop share.
Oh, can I share?
Yeah, you can share.
Okay, cool. All right. Can you guys? And I'm going to bring Kimmy on here to my business partner to go through this. So can you guys see that?
Yes.
Okay, cool. So this is basically then we're just going to go through a case study. This is another form of investing out of state. It's our form of investing via a syndication, or another term for that is a group investment. So, and I think we'll just, I thought this would be helpful for you guys because we're just going to go through the way we analyzed it, what we look for, what were some of the important factors for us. And I think that'll be, hopefully educational for you guys because, what we love about Lenska is she's so data driven and really looks at the analytics. And so I think by going through this case study, we're going to be highlighting a couple of things that are like really important for us before we even dive into a specific project and start fishing for a specific project in the area. Number one for us is area. The area has to make sense first. So Kimmy, are you on?
Yes, I'm here.
Okay, so we're just going to go through this. And Lenska, how quickly do you want us to blast through this?
I think 20 minutes or so.
Okay, yeah, that's cool. All right, we'll just go through it. And,
I haven't had dinner yet, so.
All right.
Just
and
kidding.
Yeah. And then we can have a short Q&A after.
Q&A,
if you want.
yes.
Is that how you do it?
Yes.
All right, cool. All right, so this is St. Charles. So St. Charles is those quotes that you were giving and the comments by your reader there is so true for the area. So this is almost like a totally different land once you get outside of St. Louis. This is St. Charles County, which is one of the more affluent regions in the area. So anyway, we're just going to go through this. So here's a description.
So this is a 47 units apartment complex in St. Charles, Missouri. Okay, it's a large townhome style units with private basements.
I know for Californians and in other parts of the country, that doesn't sound like a big deal, but for those of you who are familiar with Midwest, basements are big. Okay, and to have basements, and these were nice sized basements, 500 to 600 square feet that you can use with multiple uses and purposes. And it's rare for like an apartment community to have basements. So this was a big deal because just about every home there, I mean, they love their basements there.
Yes, it's actually in a great location close to Interstate 70 and Highway 94.
Yeah. And here's another thing that we look for as well. Okay. I would classify this property as a solid C+. Okay. So I don't know if that's confusing for you guys, but in the multifamily world and the commercial world, you typically have A properties, B properties, C properties, and even D properties. D is probably your war zone. C is working class. A class is typically your highest rents in the area, and typically they're a newer product. And then B is probably 10 to 15 years old. Once upon a time, they used to be A. So this we would classify as a solid C plus property. Probably don't like to go below that, and definitely don't like to go to D. But here's what made this amazing for us. It was a solid C plus property located in a B area, solid B area, and not that far away from an A area. Okay, so that was very compelling for us. That's one of the big factors we look for. Anytime we can find that equation, we get very excited.
So it's a nearby $80 million commercial development and a fast-growing Lindenwood University.
Yeah, and this was literally like less than a mile away. This is another component that we look for as well, okay? Because what's that term? A rising tide lifts all boats. Okay, there was a lot going on in this area, and you'll see the numbers on how affluent this region was, but this was literally going on less than a mile away and probably within walking distance.
Yeah.
Okay, so that was a big factor.
So that property has the same ownership for the last 40 years, and the seller is retiring, liquidating their real estate holding.
Now, here's another tip for you guys. If when we look back on some of the best deals that we've acquired over the years, they've been older. They were in the process of liquidating their estate. And a lot of the times they were wealthy. Okay. And what we've also found is like a lot of them, they might have had a property management company, but sometimes they were just self-managing. Okay. So older. Oh, and here's another thing. Throw in another component. It was in escrow.
Mm-hmm.
So we got in backup position. So you tie all those elements together. Okay. Older, liquidating their estate. And if it's a pending escrow, okay. And if it was self-managed and they were friends with the residents. Why is that so important? They
don't raise rents.
They're not overly
not
concerned about optimizing rents. So here it was, this property was sitting, what was it? 25 to 32% below market rates because he was friends with the residents. Okay. So the good news is, and like I said, I can name, I could think of a handful of properties right off the top where this situation existed. The good news is you can target based on age, age of the owner, age of the property, and how long they've owned it. Okay. So,
it's actually, this is a value play. Rents were well below market value. So
yeah.
it's a cash flowing project that has a value add component.
Yeah. Our favorite type of play, of course, they're still available. I mean, we're still finding them. It's just like we have to go through 2 to 3 times the number of deals just to find them, but a stabilized value add. So stabilized meaning that it's already occupied, and the bank usually defines stabilized as 90% occupied. Okay. Mm-hmm. So it's spitting off a cash flow, but it's got some kind of value add component that once you accomplish it and once you work on that value add, it bumps up NOI, net operating income, and it bumps up the value of the property. And this was our favorite type of value add. A value add could be like, oh, maybe the property consists of 5 buildings, but one of them got burned out. That's a value add. Or it could be poor property management. Okay. And just by putting in, competent management, you can turn it around. Remember what the story was, the owner really wasn't interested in optimizing rent. So here it was, after 40 years of ownership, he fell way behind, and he was 25 to 32% below market. So that's our favorite type of value add.
So the business plan was to renovate the interior units through normal attrition, spruce up the exterior, increase rents, optimize operations, and sell the property 3 to 5 years. And the projected annual return to the investor was 15 to 20% annualized.
Yeah. And that sounds like a repeat, that's like a standardized plan for us on what we, because of the type of thing that we look for. So here's some things that we look for in the area. Okay.
So median household income projected is $94,000 by 2020.
Okay, I'm saying 2020, but remember we bought this. We just exited
in 2019,
2017 or so. Yeah. Okay.
Median home value was 183,007 versus 147,800 in Missouri.
And I know those numbers still look stunning to Californians, right? Now it's crept up a little bit. Okay, it's not that. I'm giving you numbers when we were analyzing at the time and some of the things that stuck out for us.
So the crime index, well below average at 173 versus 284.7.
Yeah, 286.7 for the US average. So I don't know. I know there's a lot of, and Lenska can probably give you a bunch of platforms that you can go check out the crime stat. But one of the things that we do a quick check on is like city data, and city data has a gauge from like 0 to 1,000, right? And it shows you what the US average was. And for us, we like to see the crime stat at 500 or below. Okay. Or if it's slightly above that, but at least it's declining, that's okay for us. Well, the crime index, according to city data, was even below, significant below the US average, well below that 500 benchmark for us. Okay, so that's a factor that we strongly look at as well.
Growing population.
Okay, Lenska mentioned this earlier too. This is big for us too. The two things we look for, I think, are the most common, right? Job growth, number one. We like to see positive job growth, although in 2020, 2021, that was kind of like a screwed up statistic that you couldn't make sense out of, right? But in general, right? Job growth and growing population. Now, there are many pockets throughout the Midwest and the Rust Belt that did not have growing population, but had declining population. But believe it or not, St. Charles, Missouri, St. Charles County in general, and we took a look back all the way back to 1990. So 3+ decades, 2.5 decades, I guess, at the time, never had a dip in population over a 3-decade period. Okay. And it was pro job growth, and positive population growth. So that was a big factor for us.
Low unemployment rate. It was
Yep.
at 3.1%.
Yeah. So these were stats when we bought it. So those were what attracted us to us. So we'll just share some numbers and we'll give you a little bit of the backstory on it.
Okay, so asking price was $3,750,000. The future value is $4.7 million. The loan balance, it was free and clear. Value play, rents 25 to 32% below market rate. And we bought it at $3.4 million.
Yeah. So now I don't want to say that didn't happen overnight. It really took some finagling, some negotiating. I think at one point we even threatened walking away from the deal. Okay. So we're very patient. If once we've got a strike price or we've got certain terms in mind, we're always willing to walk away from a deal. That's why for us, deal flow is like one of the most important keys. We never feel like we have to do a deal. Okay. We always like to have multiple deals in the hopper, so we never feel compelled to pull the trigger on anything. Okay.
Okay, the terms is 20% down, 80% Freddie Mac loan, 30 years loan at 4.59 with the first 2 years interest only.
I know some of you guys are thinking, oh my God, you guys paid 4.59%. Okay, remember, this was back in 2017. And it's funny to me how when we talk about 5%, a lot of people freak out at that, thinking that that's a high interest rate.
Mm-hmm.
But man,
But
not for commercial or multifamily. That was a stunning deal because because it's different. It's multifamily.
Yeah, exactly. I know, but I'm talking historically too. It's like historically, when you look at that interest rate, anything 5% or below, even 6% below, I think is phenomenal.
Mm-hmm.
Yeah.
Historically, I still remember what in the was 82, 83, 84. What did interest rates get up to? If you guys can believe it, I know a lot of you.
No, don't remind us because it's coming to a city near you soon.
Hopefully not that 19%, guys. Believe it or not.
And we have some, we are a small group, and so Eric is asking, did you need to shop around for the commercial loan?
Oh yeah. Yeah, that's another thing we're definitely shopping around too. And actually the first lender that we got, actually, we ended up not going with that person because they changed the terms on us.
It was a local lender though.
It was the local lender who changed the terms on us. They went from a 25-year amortization
To 20,
to a 20. That doesn't sound like a big deal,
but
but you're
threw out-
talking about whatever that was. Was it a $2.7 million loan?
Yeah.
But it basically bumped up the payment. So this is why you always got to have, you always got to shop the lender, and you always got to have a backup.
Yep.
Okay.
Since,
And
since,
that's a different story too.
Yeah.
Oh,
So
go ahead.
since you're on question, do you want to continue with the other question too, Lenska?
No, I just, that was just timely, so I wanted to get that
okay.
out.
Oh, okay, cool.
And I think people can unmute them. I wanted a little lively,
Yeah, man. Feel free to ask questions as we go along here,
Yeah.
because I don't, we don't want this to be come off like a boring lecture. That's not the intent here.
Was Stephen Yang asked about cap rate on the property at the purchase? Is that right, Stephen?
Oh boy, I'm fuzzy.
Yeah,
on
sorry
this.
about that. What
Yeah.
was the cap rate with the asking price of what 3.4? You guys put 20%, right? And
Uh-huh.
I'm assuming you guys increased the rent to the rent you guys are getting at in the future, right? At the 30% markup. What was the cap rate at the new rents versus the old rents? 'Cause
Man, you know
have,
what?
like,
Yeah. I'd have to consult our PPM, but I'm gonna take a crack at it. I think going in cap rate was 6,
Okay.
like 6.1, and then we underwrote it, I believe, as exit cap rate at 7. So if we're typically, so that's why we just try and create a little bit of a buffer there, just in case things and the environment and the economy change. So we want to be a little bit more conservative. So I don't know if you guys are following that, but when you increase the cap rate, when you underwrite your exit price at a cap rate that's higher than your going in rate, that's a conservative move, because as your cap rate goes from 6 to 7%, your purchase, the price lowers. Okay. I know that sounds counter, right? But if you're selling it at a 6 cap, you get X price. If you sell that property at a 5 cap, your price is actually bigger. If you sell it at a 7 cap, your price is lower. So you get, hopefully that made sense.
Yeah. Now, do you have a number where you looked at the rent rolls? So if you had the rent rolls, how much rent was it bringing in when you bought it? Because you said this was all undervalued.
Yeah. And I think what's most important there is to basically take a look at, we basically shop. We go shopping and we're pegging, it's all in our business plan by the way. So we're shopping 4 or 5 different communities that are similar in the area. And we're finding out exactly what they're charging for rent. And that's how we come up with the difference, and how we knew it was 25 to 32% below. Okay.
Well, so I want to add to that. So really, when we buy, we really don't look at so much on the cap rate, because we look at on how the cash flow, what we can pay to the investors, to see if the deal makes sense. And the way we look at it is the cap. We tend to use the cap rate as an estimate of what we would sell at exit, but we really don't use cap rate on a purchase per se.
Yeah. We're not saying, I don't know if you followed that, but because everyone wants to know the cap rate, right? A lot of buyers will talk about cap rate. A lot of brokers will talk about cap rate. Okay. We honestly don't put a huge emphasis on cap rate. Okay. Because, look at it this way. And what Kimmy was saying there, because the way of our style of investing is syndication. And remember, what a syndication is basically just a group investment where we put a group of investors together to partner with us on these deals. And because a lot of our investors are cash flow investors, what's most important to them is, what's going to be my monthly distribution? What's my quarterly distribution? And when does it start? And so for us, the most important metric is cash on cash return.
Yeah.
We like to see a cash on cash return overall for the project of 11% or more, because that allows us to deliver a decent and strong cash flow return to our investors. I don't want to demean cap rate, okay? But when you look at cap rate, so for example, on this property, what is the cap rate? So what's most important is like, what is the difference here? Okay, here you are looking at a property that's 25 to 32% below market. It's going to have, the cap rate is going to be distorted a little bit, right?
Yeah.
So because you know that like if they were at market rents, the cap rate would be totally different. So cap rate is important, yes, just to have an idea, but you got to know some of these other factors, you know, cash on cash, debt service coverage ratio, and market rents. Where do you sit compared to what true market is? Where can you really take it? And then you got to take in other factors like, you know, what is the growth rate? What's happening? What do you anticipate in the next couple of years? So you have a gauge on where you can take rents.
But we were at the purchase price at 3.4, 20% down. So you had to raise, okay.
There you go.
We're
Yeah.
all in.
So that's what we came in with. Okay.
Yeah,
we put a
so you
small group.
needed obviously the 20%, the 680,000, and then rehab budget,
go.
acquisition fee,
Oops. There you
closing
go.
cost.
Yeah.
And reserves. So
There you
you
go.
needed to raise $1 million because your payment, your monthly payment on the 4.5% loan was about, 11, let's call it
No.
11 to 12,000.
14,000.
14? Okay.
14,000 PITI.
Yeah, okay, so 14,000. So you need to make sure, because your plan was all along to sell it in between 3 and 5 years.
Yes.
So
that was
for the
plan.
people on the call, the point I want to make with that is you don't have to be necessarily active and running around from town to town and find the investment yourself. If you find a group like you, and you are in San Diego, right?
Mhm.
So people can get to know you and stuff and still invest obviously their cash or their, money, because you do all the work.
Yes. Yeah. This is, a syndication. When we bring in financial partners, they're basically limited partners. Okay. So, but it's, so most of the investors who come into this, of course, they're passive investors. The majority of investors are passive investors. They write a check and want to collect the check. Okay. And still generate nice, strong double-digit returns. But we also have a good block of active investors. Okay. Active investors who maybe they want to diversify. Okay. Maybe they want to start flipping some of their active income to passive income, which I think is smart. But one of the biggest reasons, actually, a couple of reasons why active investors invest. They want to look over our shoulder and learn and find out what's going on. And so we're always available for that. That's another opportunity. But here's another big one.
Bill,
Okay.
Bill, one step back. So we know all that a passive investor is, I write a check and you do. So what is, in your scenario, is an active investor? They're the ones who driving out or flying out to St. Louis and interviewing property management companies?
Oh, no. When I say active investors, just to delineate, I'm just saying our partners who invest in our deals are passive investors. They don't have to fly anywhere. Okay. But what I'm saying is, you know how, because we're active investors, a lot of you guys are active investors. When I say active investors, you actively find, negotiate, structure, and put together your own deals, right? And if you know how to generate returns, you almost get the attitude that, why would I invest in someone else's deal if I can do it myself?
Oh, I know. I know exactly why I invest. I don't have the time, and I want to multiply my money as best as possible.
There you
So
go.
there is a question from several people. Just unmute yourself and ask the question. Stephen, you had a question or raised your hand.
Yeah, I have a couple, two-part question. So one, so going into this deal, you guys had syndication, investors. Would you guys have done a deal yourself if you were gone the other way, which is acquire it yourself and then do a hard money lending for $1 million down payment? Because essentially, you guys, the way you guys thought about it, okay, I can get 5 investors for the $1 million, or I can just do the deal myself and put a portion of the $1 million down and get hard money lending as well, and then get the rest of the loan from the bank. Is that how? I mean, what other way would you guys do it if this was? If let's say you have a 2-people team and you want to acquire this deal yourself in St. Louis, how would you do it?
How would you do it? Okay, so like
or for the financing structure,
yeah.
So
You could do it the same way. Okay, you could do it the same way. I mean, like this was available for a Freddie Mac agency financing debt, right? Because it was stabilized. That's one of the requirements for institutional financing, meaning Freddie Mac or Fannie Mae, which is the best type of financing out there, right? So you could go out and get institutional debt on it. So 80%, I mean, if you're just trying to buy this on your own, I think that's what you're asking, Stephen, you could, if you don't need investors or you don't want investors, you can put up to 20% down yourself.
Well, I prefer not to use my own money, right? Like
Okay.
or I don't have $1 million in just reserves just to put down and be doing it myself. That's why the hard money loan will be a portion, because I mean, you guys want to rehab this, and most hard money loans in St. Louis will more likely do 80% of value of the home, right? Right. And that's the thing. I don't have $1 million, so how would I go into this deal? Like, if I want to purchase for 3.5 mil, and I need $1 million, and I only can put down, let's say, like.
I got you. How else can you do it? Like, you're basically saying, how could I take this down myself if I want to just do it? So, Kimmy, how would you help Stephen out? How would you do it?
Well, I think it's depend on how the finance is being structured. Okay, so if you're taking out a loan, right? Most lenders don't like you put a second on it. Okay, so if you cannot put a second, you cannot bring a hard money lender in, because they want to be on the loan too, and they don't want to be on the second. So the investor we bring in, they're not on title. They're just investing shares into the LLC. So we actually bring equity to the deal. So the way we structure is, they're not on the deal. They're buying shares to an LLC that holds title for this project. So that's how we've been able to take down the project. So the answer to your question is, if you can find a lender that would be in second position, and the first will allow that, maybe that is a better route to go. But I actually don't know if there's a lender that okay for you to put a second on there, or if the second want to be on the second.
It might be tough. So just put yourself in that second. You want to go out and find a private loan or a hard money lender to basically give you the $1 million to go on top of the first.
Yeah.
Okay. So another problem you're going to have is the 80% first mortgage. I think in this scenario here, they don't allow junior debt on top of the first. Okay. And if they do find a junior debt on top of it, they have the right to call the loan.
Yeah.
Okay. That's good to know, because I asked this. You guys got it for 3.4, and the future value is 4.7. So that's over $1 million in equity right there that you can pull out instantly to pay off your second lien.
Yeah.
No,
not instantly.
instant.
No, not instantly.
You got to develop it. You got to develop that.
Yeah, because remember.
How long did it? So I guess my question is, how long did this rehab took? Like, was it like a 12-month? Like, how long did it take you guys to rehab all of the apartment?
It was
over 12 months.
It was close to,
okay.
because we don't empty the building. We don't empty the units. We renovate when they move out.
Through normal attrition.
Yeah.
Okay, that makes sense.
Yeah. So it's just like the way we do it is just one way to get a deal financed. Okay. Just because we have we have multiple deals.
Mhm.
Okay. I mean, this is one deal out of many that we do. And so, but in order to take advantage of all the great deals that are in our hopper, we have to basically use leverage, use OPM, and use the power of syndication, which we love because we think it's a share the wealth type approach, because it allows others to get involved in your deal and generate tremendous returns in a passive way. So
we
it's
have
one way.
we have a couple of newbies on there, so I want to make sure that they understand that there are various ways to invest in real estate, out of state or in state or in your backyard, right? So you can buy real estate and you own it, right? Or you can invest in an LLC. Practically, this is how this deal
Similar.
was
That's
taken down.
basically, yeah, what you're talking
And
about
you
here.
are actually investing in the LLC. So the LLC is run by a managing member. So you practically not only need to do the due diligence on the location, on the building, you also need to do the due diligence on the managing team.
That's most important, actually.
Yep.
And that is exactly, so that is one of, because you don't own, I mean, the LLC owns the property, right? Because the question becomes, what happens if the team doesn't perform or, goes on vacation and nothing is happening, right?
Right.
So it's not, so that's what you need. And that's why I wanted to bring this up as a one of the first investment opportunities, because obviously there are other companies who have different deals and you can invest in. I mean, there are REITs, there is, it's all sorts of other investment, but I know I've known Bill and Kimmy anyways for a long time. And it's not their first rodeo, this one. By the way, how did your Fresno deal? Are you still in Fresno?
Nope, we saw our last one. We're out of there.
Oh, good. So as you can see, but I wanted to introduce you and how you do it and all this. So I think hopefully that was helpful for the newbies. And
I have one question. Do you have to be an accredited investor to invest in the syndication? Like some of them have such requirements.
I would say, oh, go ahead, Kimmy.
There are two ways. So usually the syndication is set up two ways. The first one is called a 506B. But 506Bs allow accredited and non-accredited investor to invest in the deals. And then there's another one, which is a 506C. 506C can only have accredited investors invest in the deal. Accredited investors are individuals who have assets of $1 million or more, excluding their primary home. Or if they're single, their income is $200,000 in the last 3 years. And if they're married, 300,000 in the last 3 years. That's how you define it.
Okay, got it.
Yeah.
We have both.
Yes, we
Okay.
have both. I wanted to go back to Lenska, what she's talking about. I think when you want to invest as a passive investors, I think there's a couple of things that you need to do. The first thing is you have to understand the deal itself, and then you have to know who is managing the deal. Okay, so you got to vet them to make sure you're comfortable investing
Big time.
in.
That's your main job,
Yeah,
basically. Yeah.
So I have people ask me a lot of questions, and at the end, and I said, your job is to do your due diligence, to get comfortable putting your money in. And if you've done all that, and at the end you're still not comfortable, don't invest in it.
yeah. And Eric, please ask your question.
Hey, thank you. So yeah, I had a quick question. You had mentioned that one of the great things about this specific deal was the fact that, the owner was a little on the older side and, there was the market rents were about 25 to 30% lower. I just wanted to see if you could provide any insight on how to find these value add opportunities in like such as like an older owner is about to retire or like of a lack of systems when you're investing out of state.
How to find the deal. Yeah, it sounds like you're on the hunt, Eric.
I've been listening to a lot of like Jake and Gino's podcasts as well as bigger podcasts, and they kind of mentioned like, or Jake and Gino has mentioned some of these factors that can be like good deals that you can find out, such as the older owner that you had mentioned. Also like lack of systems with like paper, handwritten like payrolls and things like that. So I just wanted to see how you guys.
We've done it. Yeah, we've done it multiple ways, man. I would say at any given time when we're really fishing in a market, we probably have 4 or 5 fishing lines out there. Okay, so number one, I think in any given market, there's probably a handful of brokers who probably who control the deal flow in the market. Okay, I think that's a good use of LoopNet is to help you identify who those top 5 brokers are. Okay, and so build relationships with them, but not for the purpose of like, hey, if something comes across your desk, let me know about it. What you really want to do is build up the relationship to the point to where they actually actively solicit their customers, that you've got a ready, willing, and able buyer actively looking for stuff now, and they basically put out the word. Okay, basically getting those top brokers to beat the bushes to go find off-market stuff. Another way we've done it as well is
hold on before you go to the next one. So in order for them to know that you are a serious buyer potential, you have to have specific and clear criteria of what you're looking for.
Big time. If
you come in and you tell them, oh, I want a good deal.
I want a great multifamily deal.
Yeah. How do you define it? Okay, because good deal is relative. Okay,
right.
So you got to know. Okay, I want this and this price range. How many units? This is kind of you have to define those things, because when you start defining those things, then they said, oh, this person have thought about what they want to purchase. Okay, they're at least serious about it. But if you come in and you say, oh, I want to buy a good deal, and how much are you looking for? I don't know. How many units? I don't know. What price range? I don't know.
What zip code? No clue.
I don't know.
It starts with you, man. You got to get crystal clear on a bullseye of what you're looking for and what's most important to you. Otherwise, no one takes you seriously. So that's one big time strategy, right? Get them to basically go find those hidden market or off market deals where they beat the bushes. Another thing that we've done very successfully is, utilizing a list service like Reonomy. I don't know if you guys are familiar with that, but it's a database listing service that basically gives you name, contact information, address of the owner. Okay. And so, for example, in one market that we were in, we had a universe of all multifamily properties. You can do this for single family as well. Okay. But we had a universe of 6,300 multifamily property owners in this given area. And we had 2 people who basically did nothing but cold call.
Yeah.
Okay. They weren't super sophisticated. They were in their early 20s. It was basically just to see if they were interested in selling. That produced a number of deals for us that way. Okay. And if you really want to soup that up, what, Kimmy?
Oh, no, I wanted to, there is, Philip has a question.
Oh, okay. All right.
Quick question, without getting too far in the weeds, when you guys first started partnering up, or however that went, and it was your first syndication deal, right? How were you selling investors when it was your first deal?
How were we selling investors?
What were you saying to them? When
You know how you always start. Ask family and friends.
That's how they
place
did
to
it.
start. It's a good.
I'm saying when you guys started first doing your syndication deal, you have to obviously pitch investors to invest.
You know how we start? Okay, I'll give you how we started. We didn't start with a syndication. We actually started with, going to people that we knew, but it was basically, we started out, remember, I got started in the single family space. And when we started growing and scaling that, of course, it started out 1 tier, 2 there, and then it actually grew because we were buying at the courthouse steps. We were buying in bulk from larger sellers. And at one point, 8 to 12 properties per month. You need capital for that. So we started going to people that we knew, and then we started expanding that. Okay. And it was not a syndication. It was what do you call it?
Joint venture.
No, it eventually evolved into joint venture, but it was private mortgage lending.
Yeah.
Okay. We were basically offering them a fixed rate for the use of their money. It was anywhere from 8 to 12%, if I remember right. And we would give them a promissory note secured by a deed of trust or mortgage, depending on where that property was. So it was typically, a lot of times, because the properties were so cheap, it was one investor per property. And so you build up a bank of private lenders that way. And then you eventually, and that they liked it because a lot of that was short term. Some of it was up to 2-3 years or longer, but a lot of it was short term. Okay. And then so from that,
We
evolved into joint ventures, and we evolved into bigger deals, and then we evolved into syndications. Okay, so because the syndications now, so whereas the private mortgage lending stuff was maybe 6 to 12 months, your syndications are longer term, 3 to 5 years. So it's an evolving, man. It's not like all of a sudden, hey, we're going to do syndications now, we're going to go raise millions. No, it started out with, let's go get this $50,000 house. And then it just grows.
So my first multifamily deal was owner financing.
There you go.
So the owners carried back, and it's quite common in the Midwest that they do owner financing. Now I want to chime into, how do you find those deals? You need a good relationship or with a title company, or you can buy that data. But remember, Bill and Kimmy said they owned that property for 40 years. So you call up the title company, and if you have a town, you can, let's even say Rivers, let's pick a place in Riverside, city of Riverside. Please give me all the addresses of the properties that have not changed hands, because remember, that's all public. You can even go down, you could go to the county recorder, right, and look it up yourself. The properties that haven't changed hands in 30 or 40 or 20 years, right? So that's how you find us. If you want to be boots on the ground and go, drive by there, and then you go, if you're a member of, for example, SDCIA, you have access to IDI Core, which gives you the email, the phone numbers, and the address of the owner, and you're just going to call them up or send them a letter yourself. So if you don't want to deal with real estate brokers.
Yeah. And consistency is key.
But now in the Midwest, let me tell you, because I am in Mississippi, it is a good old boys network, and a lot of people know each other. You might be better off booking a flight and hanging out at the local bars. All right, do we have any other questions? Good. Profit projection, you holding back on us.
Oh, here, let's just go through it, blitz it real quick, okay? And then we'll finish up.
Okay, so the exit strategy: renovate the unit, spruce up exterior, optimize rent, sell 3 to 5 years. So the projected sales price was $4.7 million. So the projected annual ROI was 15 to 20% to our investors.
Yep.
Nice.
This is nice.
The return. She talked about the return.
No, I was saying the 15 to 20%.
Okay. You're like, what are you looking at? This is not nice.
It looks like a box.
Look beyond these pictures, okay? You're buying more than a roof.
Yeah, I see no Teslas in the parking lot.
No.
Yeah,
Okay.
it doesn't look that appealing, but it sure cash flow well. And when we exit it should give the investor a good return.
Yeah, this is not a shiny asset on a hill. So these are some before pictures, okay? Looks a little bit drab. Even though they took good care of it, they took care of the maintenance, the deferred maintenance, but they didn't, I don't guess they didn't believe in upgrades. They liked that classic look.
They didn't upgrade. There was no renovation.
And so these are some after pictures. You might be thinking, these are after, these still look like before. But, we put a splash of, painted up the brick here to give it a little bit more splash, spruce up the interior, painted the sign, and just gave it a nice little exterior facelift. We spent a lot of money on the kitchens. Okay.
Yeah, those are nice.
Yeah. New kitchen cabinets, backsplash, granite countertops, stainless steel appliances, tile flooring. And so this was our general look.
Nice.
Okay? And a very similar thing that we did in the bathrooms, right?
And who was in charge of finding the contractors?
We have a boots on the ground partner who was like right on top of it, managing and driving everything, which is important. If you're going to be doing a multi-million-dollar syndication out of state, you got to have boots on the ground. Got to have boots on the ground. And one of the things that we do as well is we always do pop-in visits. So unannounced pop-in visits. So that's what keeps us floating around.
So then I'm all with this with the one person that was on the call saying to buy someplace where you want a vacation.
There you go. Oh no. Okay. Well, I guess that's one way of doing it. Definitely.
Pop-in visits and stay there.
And stay. Yeah. So, but again, also going back for the single family rentals. Yeah. I mean, we can do a lot of like tenant. If you can find your tenants, you can write up the leases all over DocuSign and digital. But you do have to have one trusted person that's out there, be it a handyman, a family member, for single family homes. Because even if you're hiring a property management company, you still need to manage those.
Big time. So, I think we already went through that, didn't we?
Yeah, we did.
So how we sold and profited. This is the punchline.
Okay, so end result, we sold in less than 4 years. Sales price was 4.925. Annual ROI to investor was 16.84%.
Yep. So we surpassed the sales price, and that's it.
Great.
There's just one small example of the types of deals that we do, the types of deals that we like, and some of the factors that we look for in all of our deals. Right. The primary ones being job growth, population growth, and we're really paying close attention to migration patterns.
Yeah, excellent. And then obviously when somebody had the question, I think was it Matt who had the question regarding the how to win investors over. So for me as an investor, obviously I would like to see comps of apartment complexes with that unit mix that sold for 4.7. It's the same like you're doing a fix and flip, right? After I'm done, it's kind of an apartment fix and flip. After I'm done, can I sell it for 4.75, which was your target, right? Do you provide that in a package?
So we have what's called a PPM, which is a private placement memorandum.
Okay.
In the private placement memorandum, you will get the business plan. You get all that you ask for, the comps, the rent comps, the sell comps. You get to know the principals. You get to see the past projects.
Over 100 pages per project.
We're out of time. Thank you all for attending.
What projects do you have coming down the hopper? Do you guys got anything going on now or what?
Yes.
Yes.
Okay.
Yes.
Do you have your information? Do you want to put, how can people get a hold of you, please? Bill and
Kimmy? Okay, well, probably through Kimmy.
Kimmy, your phone, you want to put it in the chat or give it, say your phone number or Kimmy at.
Hold on. Let me type it in there, okay?
See, you need to do a slide like I have.
Oh, I know. Well, we just came in here to share info. We weren't ready to, say a specific deal
I
or anything.
appreciate that, but I've been following you, and so it's Kimmy, KIMMIE at
GoDreamWest.com.
GoDreamWest.com. Okay, Kimmy, and it's in the chat. So that's contact Kimmy. You know how to get a hold of me. I have been blasting shamelessly my information.
Yeah. And we don't even have any contact information on our slides.
Yeah. So which would you disclose which town your new project is?
So you heard
go
of the
ahead.
phrase all road lead to Texas?
Oh, yeah.
Yes.
Okay. But Texas is a big state.
Yeah.
Don't tell me Austin.
No.
No,
Good.
we actually have multiple projects. We close Wichita Falls. We have Lubbock, Texas.
Texas.
And we have Texas.
And our
then
latest one,
Dallas.
Dallas.
Oh, good. But it's outside of
DFW.
Dallas?
It's about
Midtown.
yeah,
Now, I heard
Midtown.
outside of Dallas right now is hopping.
It's yes, but this little segment there, you know how that we showed you that example where they had this $80 million, that development, by the way, in St. Charles was called Streets of St. Charles. And it's like, anytime we can find that component, it's like a rising tide lifts all boats. It really lifted up that area, right? They've got less than 8 minutes away, a multi-billion-dollar investment going on in this area.
Yeah.
It's projected to be the downtown of the Midtown area. So just a little teaser for you guys.
I actually just got back from Dallas, living there for 5 months. I know Midtown.
You know what you're.
I know exactly.
Tell us about it, Stephen. What do you? Is it good? Good? Are you indifferent? What's your feeling about it?
Yeah. I like Texas. I like Dallas. I like Austin. I just wouldn't live there myself. But as I think it's a great place to invest. Property taxes are a bit high, but I mean, that's what you get for no state income tax. But yeah, I like Dallas. There's a lot of opportunities for multifamily, but Midtown is growing. I mean, that little section, maybe quarter mile stretch from north south, and it's just popping. I mean, there's
man.
I mean, if you guys know Dallas, MSU is like what, 10, like a mile away. Like it's like 10 minutes drive from so it's a lot of good areas in that little section of Midtown. So
there you go.
Perfect.
So a highlight from someone who just lived there for 5 months. But remember, I said earlier, one of the things that we look for, if we can find, one of the things that we liked about the St. Charles project was C+ grade property, solid C+ grade property in a B area.
Well,
this is a C+ grade property
in an A area.
I don't know if it's like an AA area, but like
becoming okay. If not,
well,
if not
like, go ahead. I'm sorry to cut you off.
No, go ahead, Stephen.
Oh, I was gonna say like this like the west side, once you go towards the freeway, that's kind of like the sketchier area. So once you come out of Midtown, going away from the city on the west side, that's where it gets kind of sketchy. So I think that's kind of like you're in a little tight bubble when you're in Midtown and downtown. Anything outside of that, south and west and east, is kind of like, it's not the I guess C grade level like material, I guess.
Yeah. I got you. Okay. Well, that's one.
I'm just going to stop the recording because I don't want even going longer. That doesn't mean you guys can stay on. So I tell everybody thanks for attending, and more to come.